This is No Lazy Money with Nick and Jim from Peak Wealth Management. Real people, real money, real talk. And your host, Ryan Ermanni.
Welcome to No Lazy Money on WJR, where we don't sugarcoat it, we don't hide it, and we make sure we do not let our money sit around and do nothing. We've got real people, real money, real talk, zero laziness allowed. We're with our friends from Peak Wealth Management, Nick Hopwood and Jim Pilat. We encourage everybody to check out their free Social Security analysis at peakwm.com/WJR. We also want to remind you that we will replay this on our YouTube page, youtube.com/peakwealthmgmt. That's youtube.com/peakwealthmgmt. You can watch the replay, and again, a free Social Security analysis, peakwm.com/WJR. We're coming right back with Nick Hopwood and Jim Pilat, 760 WJR. No Lazy Money here on 760 WJR with our friends from Peak Wealth Management. We bring in Nick Hopwood, the president and founder of Peak Wealth Management, and Jim Pilat, the vice president. Fellas, Happy New Year to you.
Happy New Year, Ryan. Thanks for having us back.
Absolutely. So, first of all, Nick, talk to me about planning the new year, 2026, right? Everybody wants to get off to the right start. What is your message to people out there?
Yeah, it's a great time to think about planning, like you said, first of the year. And so many times when you're talking about financial advice, you go to a financial planner with air quotes, okay? And they're just not doing planning. It's just all about the investments. So Jim and I have a culture at Peak Wealth where we are CFPs. We lead our team of CFPs, and it really starts with the planning. Right, Jim?
Yeah, I absolutely agree. It's hard to, we believe it's hard to make investment decisions until you know where we're trying to go. What goals are we trying to achieve? Where are we trying to get to? Are we on track? Are we doing the right things? Those are the first questions that we want to ask people, not look at our returns and, that kind of talk that we find that comes out of a lot of other advisors.
That's a great point, because so many people, I imagine, want to run before they can walk, and you can't run until you get a better picture of where people want to go. Is that what this is all about?
Yeah, you need to learn about people's goals. We want to make sure that we have those in mind all the time. And oftentimes people haven't even thought about what their financial goals are. So we help people make sure that that's outlined, and we see where we are today. And if we keep doing what we're doing, how will it look in 10 years and beyond? And so, like Jim said, it's not all about the investments. The investments are very important and critical, but we have to take a step back and think about the overall comprehensive plan first. And it saddens me that so many other advisors out there are not talking about planning at all, and they're only talking about the investments. And I think it's the culture of where you start when you're, starting your career. For instance, I had an internship at a company, and it was totally insurance focused. So everyone got a variable universal life insurance policy, whether you need it or not. Jim has a similar story as well when he started out.
Yeah, I also started at a company that was owned by an insurance, and that was the focus, is how many annuities, how many life insurance products, those are the kind of things that they wanted to track. It wasn't how many financial plans did you do or how many people did you help make a good decision. It was about the product.
That's an interesting point. How much, you guys are talking about, when you have people come to you, you want to learn more about them. Some of the questions that people that come to you, what should they ask you? What are some of the questions that people should come into your office and ask you about? Because I believe in this financial planning atmosphere, there is a relationship that absolutely has to build, and trust is a big part of it. And I know, as you learn about your clients and what would suit them, they too probably would want to know whether Peak Wealth is the right opportunity for them or not.
Absolutely. They should be asking, are you a fiduciary, and what does that mean in real terms, in reality? Because a lot of people say that. So what does it really mean for your practice? Do you charge fees, and what are the fees? Do you charge commissions? How are those commissions charged? How many clients do you work with? What is your capacity to take me on as a new client? What is your investment philosophy? Those kinds of questions would be what I would advise you to ask a potential advisor.
Those are so important too. I mean, you just nailed the top three that I would think that people out there seeking financial help, a financial plan, would want to know from their advisor, right?
Yeah. And in terms of fiduciary, Jim, if I may, there are no guarantees in this business, right? But we do offer one guarantee, and that is that all advice that we give is always in your best interest and not ours.
That's an important point, Jim.
Yeah, absolutely. I think it's really, going back to what Nick said originally in this, it's how you're brought up in this business and how you think about it. And that's got to be the forefront of your mind as a financial planner, I believe. We were talking about some of these things, and Nick mentioned questions to ask, or, people always want to know about your investment returns and your costs and all these things. But I think another good question people should ask is just about your competency as a planner. Are you a certified financial planner? Have you gone through that course curriculum, passed those tests? What is your experience with planning for college, planning for retirement, planning for, short-term needs, long-term needs, and so forth? And then just looking for ways to optimize it. Because not all planners are the same. So much of what we do comes down to the assumptions we're using and things like that that can make a really big difference.
You are listening to 760 WJR, No Lazy Money, with our friends from Peak Wealth Management, Nick Hopwood and Jim Pilat. Nick, I know you're a huge sports fan, and one of the things that you talk about in sports a lot is culture and the workplace culture, what the culture is in the building. That's kind of exactly what you're talking about within Peak Wealth Management. What is our culture? What environment do we work under for you?
Well, I think the culture that we're trying to build within our staff and our team, as well as our relationship with our clients, is family.
Yeah.
We talk a lot about the Peak family, and we give hugs, we don't shake hands, that kind of a thing.
I love that. I was talking to my producer here at WJR, walked up to her, gave her a great big hug. That's what you got to do, right?
Well, yeah, how else can you build a culture without that family feeling, right? So I think in terms of another question people want to ask, though, beyond the culture part, is when you're coming up with your investment recommendations and your planning recommendations, is there any ulterior motive? Okay, so we are independent by nature, which means that we can recommend strategy A, B, or C. We charge the same fee. There's no incentive for us to recommend company A over company B in terms of extra compensation, or you scratch my back, I scratch yours kind of a thing. A trip to Hawaii kind of a thing. That's right. A big deal in sales cultures. We do not have that sales culture whatsoever. Strictly fee-based, strictly independent, where any advice that we give is in your best interest, not ours.
And that goes back to the trust building part of the relationship that you have with your clients or potential clients.
Absolutely. So when you receive a call from me, you know that I'm not trying to sell you anything. And that's important.
No doubt about it. I mean, as somebody that, we all want to work with our money. We all want to work with people that, that we trust. And you have to trust that moving forward. I think that's a very important point.
Yeah, the last thing I'll add, Ryan, is that in terms of culture, we don't work for the New York Wall Street Bank. Mm-hmm. We don't work for the mothership out of New York City. Mm-hmm. Jim and I, own the firm. Okay, we own the firm, but ultimately we work for our clients. They are the ones that pay us our paycheck, so to speak. And so keep coming back to, that culture, that independence, that fee-based. We very much work for the client, and we understand that.
Sit tight, fellas, because more coming up. We're going to talk about asset allocation, growth over value. We're going to talk more about what you guys do, what you can provide for potential clients out there. We want everybody to get their free Social Security analysis as well. Go to peak.gy peakwm.com/WJR. Again, that website is peakwm.com/WJR. You're going to get a free Social Security analysis, and we invite you to watch this broadcast as well. We're going to replay it on the Peak Wealth Management YouTube channel. That's at youtube.com/peakwealthmgmt, youtube.com/peakwealthmgmt. We're coming right back. No lazy money with our good friends Nick Hopwood and Jim Pilat from Peak Wealth Management. You're listening to 760 WJR.
You're listening to No Lazy Money with Nick and Jim from Peak Wealth Management. Real people, real money, real talk. Once again, here's your host, Ryan Ermanni.
Welcome back. No Lazy Money here on 760 WJR. Nick Hopwood, president and founder of Peak Wealth Management, along with Jim Pilat, vice president at Peak Wealth Management, here with us. Fellas, we have had a great run, and I think it's fair to say a great run over the last 3 years in terms of investment. How would you characterize it, and where are we going in 2026 and perhaps beyond?
You're right. It has been a great run. It's been a run of the ages. Even if we go back 15 years to 2009, after the great financial crisis, we had some bear markets in there since 2009. But the last 3 years in particular, as you mentioned, have been just outstanding. And so the leader of the market has been large cap growth, or think of it as large cap tech, right? The U.S. tech boom, pushed by the artificial intelligence investment right now. And so that's been leading the market. But it reminds us, Jim, doesn't it remind us of 1999 a little bit?
There are definitely some parallels that you can start to draw as far as a good 3-year period. Looking back over history, we saw that the other prior 3-year period that was about as good as this, just under, was from 97 to 99.
Yeah, that's right. And so what happened after that, Ryan? You know this, don't you?
Bust.
Yeah, that's right. That's right.
Tech bubble burst.
Yeah.
Right after coming out of graduation, right?
The bubble burst.
It did. So will the AI bubble burst in this case?
That's the question, right? I mean, that's the question.
Yeah, that is the question. So I think it's a parallel to the internet bubble of 99, but it's more like a rhyme rather than a copy. Okay.
So many people, if I can just jump in here, Nick, so many people had no idea what the internet was back in the early 90s, mid 90s, before this tech boom, the World Wide Web boom. And I think a lot of people are uncertain of what AI even means. It's fueling investment so much, but again, we go back to the question that you just asked: will we have something similar happen in the investment field with AI, like we did with the .com bubble bursting?
Well, I don't think it'll be the same.
As dramatic?
I don't think it'll be as dramatic. Yeah, because NASDAQ went down by 90%. Okay, that is extreme. It took like 20 years to get back. Something ridiculous like that. But we're seeing, like, history is rhyming right now, okay? So if we look at the S&P compared to, which is market weighted, like NVIDIA, Microsoft, Tesla, they're all at the top, right? But compared to the equal weight index, where there's 500 companies evenly split, okay? So the smallest company carries the same weight as the largest company, like Apple, okay? The S&P market weight has been outperforming the equal weight by 34% over the last 3 years. It's never been this wide. And so that starts to make us worry just a little bit, okay? Because these large cap techs are running away from the market. And so if we had a crystal ball here, or if we're talking about where to allocate for 2026, we would say, don't ignore the rest of the market. Don't ignore the value companies like energy. How are we going to power these data centers? Energy.
I hear about those data centers like crazy. I mean, every day in the news, we hear about the possibility of a new data center popping up in a city near you, and that's another big part of it.
AI cannot exist without the energy. Who else is going to benefit? Downstream, industrial companies will benefit. These other value companies who have been kind of left in the dust, so to speak. guess who did the best in 2000 through 2003? The value companies, the old Dow Industrials, instead of the NASDAQ Tech. So we're saying, don't ignore those in 2026.
Yeah, this year was kind of an interesting reminder for that as well, because international as a segment that people have ignored for years because it just performance hasn't been there, it hasn't kept up. Everybody wants to be in these high-tech companies that we're talking about, but this is a year where international actually performed really well. We saw, both large cap, international, emerging markets up over 30% on the year, which was pretty exciting and really made a case and a good reminder for us to stay diversified.
If you guys have a client that, is not in any AI investment now and wants to learn more about it, comes to you and says, you know what, I see this and I think back maybe, how many millionaires were created in the .com era, right? And maybe is AI our new .com era? I want to get in on this. What are you telling them about being cautious or learning about this? How do you go about that phone call that you may get?
I like to remind them that if they own the S&P, they're already very overweight.
Right.
They own a lot of the stuff already. Secondly, I would say, well, if we wanted to be aggressive, how much can we afford to carve out of the portfolio for this bet? And finally, what about waiting for a pullback? Because there's going to be a correction probably in 2026, which means a 10% drop in the market. If that happens, now it gets very interesting where we want to allocate and make a bet like that.
When I hear you say that, when I hear you respond that way, I can't help but go back to what we talked about in our first segment, and that is learning about where your clients, the relationship that you have with them, where they want to go, because where they want to go may dictate those answers about how aggressive they want to be, how safe do they want to play it, and that's an all-encompassing view.
Yeah, if you need money in the next year or two, we're not going to be allocating to stocks, period, let alone AI. But if it's your Roth IRA money, which won't be needed for decades, well, now I'm very interested.
We can play a little bit, maybe.
Absolutely. And like what Jim said with international, so many of prospective clients that we talk to, they bring in their statements and they're just S&P. Maybe a DIY investor, they're just brainwashed into believing that the S&P is the end-all. They don't have any value. They don't have any small caps or the international, like you said. And when we look at our strategists, they're all overweight international right now. The tide could be turning, as he said, in 2025 with the S&P trailing international for the first time in a while. And then large over small. It's been 5 years in a row where the S&P has really crushed the small cap index. And the last time it happened like this was, again, 1994 through 1998. And after that, there was a 6-year run of small cap outperformance. And so we think that you want to make sure that you have small cap exposure as well.
How often does history predict the future?
Oh boy, that's a good question. We could be having this conversation and none of this stuff happens this year, but it happens in 27.
Sure.
So you can be right on the theme, but wrong on the time.
But that's okay, though. You know what I mean? And there is no 100% of anything, by the way, right? I mean, you take a look back to perhaps give you a guide, but nothing is set in stone, obviously.
Yeah, but Jim, what happened in the 2000s for the S&P?
Yeah, start of the 2000s to the end of the 2000s, the S&P returned, what was it, -1?
-1 per year.
Yeah. That doesn't happen often, does it? If you take a look at a 10-year snapshot, that doesn't happen often, does it?
It happened in the 70s as well.
Yeah. But even so, it just goes to show you that time is your friend. I mean, to have a -1% isn't going to destroy your portfolio, though, over a 10-year period in the most crippling of times, though.
Well, if you retired in 99,
well, yeah,
right, that adds a lot of complexity. Okay?
No doubt.
And so that's when you need to make sure that you have this diversification and fixed income as well, because if you're taking 5% of your portfolio out starting January 1st of 2000, you're out of money in 16 years.
No doubt. Yeah, that's a good way to look at it. That's why you're the expert. No, I'm not. Stay tuned, ladies and gentlemen. No lazy money. We're going to talk about tax planning. We're going to talk about 401ks, IRA limits, everything that you need to know. Peak Wealth Management, peakwm.com/WJR. We're coming right back. No lazy money, 760 WJR. Lazy Money here on 760 WJR. This might be among the hottest topics, if you're listening to this show right now, that you're going to want to be glued into, and that's the tax planning aspect of where we're going in 2026. Nick Hopwood, Jim Pilat, Peak Wealth Management. Nick, talk to me about tax planning. I hear tax planning in my head spins a little bit.
Well, it is the hottest topic, as you said. And the concept of my lifetime tax rate, my cumulative tax rate over my life, not just this year. You might think, why are we talking about tax planning in January? We should have been talking about it in December. But we were. We talk about it every month. Okay, that's the bottom line. So we need to make sure that we're
every time we do the show, too, we might do a tax,
Watch out.
Tax topic. All right.
It's true, because it is our largest lifetime expense, and it's what we talk about in every meeting with all of our clients. So, at the end of the year, you might be frantically trying to buy down your tax rate, but why do you have to wait to the end of the year? Let's talk right now.
Yeah, I think that's a good point. December's a good time to think about it because everybody knows there's a deadline coming. But in reality, there's lots of ways to optimize, and we need to be looking for opportunities to do that throughout the year.
This is a bit of a loaded question, but you talk about, new tax year, and with the big, beautiful bill that was signed in 2025 becomes law in 2026. What are some of the things that people need to worry about? What are you advising your clients regarding in terms of taxes and all these qualified charitable distributions and donor advisor funds and everything like that?
Yeah, those are the two big things right now, Ryan. So a qualified charitable distribution, it only applies to people over age 70 and a half. Think about the old required minimum distribution age, 70 and a half. But if you do want to make a donation to a charity like your church or whoever it might be, you can send the money directly from your IRA, and it avoids your 1040 altogether, therefore saving you a lot of tax, because otherwise your IRA withdrawal is fully taxable. This way, you've skipped the 1040 altogether, the money goes right to the charity, and your required minimum distribution is satisfied.
Is this among the biggest financial mistakes that people make with their own money, is not taking advantage of tax law or not understanding how much money people are losing because they don't understand tax law?
It's one of them. It would be a terrible mistake to take a $10,000 required minimum distribution and then turn around and write the check for $10,000 to the church. It would be very foolish, in my opinion. Okay, because you might not be able to take that write-off at all under the tax code. Whereas if you did the QCD, you avoided paying tax altogether on the $10,000. So it could be a couple $1,000s each year. Okay?
Yeah.
Then there's the donor advised fund. People make contributions to the donor advised fund when really they could be considering the highly appreciated stock.
Yeah, I think donor advised funds give a lot of opportunity for people. It's a fund you set up. It's for charity, and money has to go to a qualified 501c3 charity. But why it's unique is right now the standard deduction has gone up so much that most people can't itemize. So in Nick's previous example of somebody who wants to give away $10,000, most people can't itemize that away, so you get no benefit for the write-off. Well, a donor advised fund is intriguing because maybe you're charitably inclined and you pick one year to kind of bunch your donations together for the last couple of years, and maybe you want to put $50,000 into this fund. Well, now guess what? I'm over the limit, the standard deduction, so now I can go and itemize. So I can find everything that I can try to do, tax-wise, to itemize, put it all in that fund, and then distribute at a later time. And the other thing that Nick was hinting to is that it allows you to donate that appreciated stock. So if you have stock that you've owned, maybe you bought NVIDIA and it's gone up and doubled and tripled and all this stuff, and if you sell it, you're going to realize a capital gain, right? It's at least, for most people, 15 to 20% of that's going to be capital gain tax. Well, if you donate it straight to your donor advised fund, you don't have to realize that capital gain. That money goes straight into that fund for you to donate and give out at a later time.
We are talking to Nick Hopwood and Jim Pilat, Peak Wealth Management. We encourage everybody to visit Peak Wealth Management, peakwm.com/WJR for a free Social Security analysis. peakwm.com/WJR for a free Social Security analysis. And, of course, we'll be on youtube.com on Peak Wealth's YouTube channel, youtube.com/peakwealthmgmt as well, if you'd like to watch this broadcast as well. But, Nick, if you want to continue on with that.
Yeah, so even if you are not itemizing, like Jim said, and you are charitably inclined, and you have this highly appreciated stock, let's say you paid $3,000 for a stock that's worth $10,000 now. It had a nice run, it tripled, and so you want to donate, you want to put that in your donor advised fund. Instead of selling it and moving the cash into the fund, you just donate the stock itself. And so thereby you avoid the long-term capital gains rate of 20%, 15 or 20% depending on your bracket, 3.8% for the Medicare investment tax if you're over that limit, plus the state of Michigan, 4.25%. So you're going to save about $2,500 in avoiding the tax. You might not get the full write-off of the charitable contribution, but at least you're avoiding the capital gains.
It is interesting just sitting here as a layperson. You know, it almost feels like the tax law and in just different ways you can save money and make it go to the right causes as well. Make it work for you a little bit. We talked about in the open, you know, making your money work for you and in many cases, this charitable donations and making your money work for other people as well. That's great news, but understanding all of that is so important.
Ryan, the donor advised fund is actually still invested at Schwab or Fidelity or wherever you set it up. And so it could be the Ryan Ermanni Foundation.
Let's go. Let's do it.
The Ermanni Family Foundation.
Let's do it.
The money is still invested, and you could make distributions from that account each year to any charity you want.
Let's talk after the show.
Let's do it. Yeah. Now, what about this? What if you have a great big brokerage account, okay, and you are tired of paying capital gains? What if you switched it into a direct indexing strategy where you are able to sell throughout the year? It's pretty much a software program that overlays all the stocks together, where you can own, let's say, you know, all the 500 companies in the S&P, you're going to own Home Depot and Lowe's, right? And maybe, and this is not advice here, not a suggestion, but maybe Lowe's is doing well and Home Depot is doing poorly, so the account will sell off the loser stock, put the money into the other similar company, and you harvest that loss. 31 days later, you can go back into both companies. And so you can actually track the S&P, like within 1% margin of error, but write off thousands of dollars of losses and carry that forward for the future.
It's brilliant. It's absolutely brilliant.
Yeah, most people are afraid of losses. Most people never want to take losses, but there's a strategy behind taking losses to give you a better tax situation.
No doubt about it. I was actually just talking to my uncle about that over the weekend, just about, you know, that strategy to work to your benefit. Sit tight, ladies and gentlemen, because coming up next, we are going to be talking about the new 401k, the HSA, very popular as well, IRA limits and all of that. Don't go anywhere. No lazy money. Right back. 760 WJR.
You're listening to No Lazy Money with Nick and Jim from Peak Wealth Management. Real people, real money, real talk. Once again, here's your host, Ryan Ermanni.
This has been such a fantastic broadcast, and we invite each and every one of our listeners today to go to Peak Wealth Management, peakwm.com/WJR. You're going to get a free Social Security analysis. Also, you could watch this broadcast if you want to hear anything again, whatever you need more information on, youtube.com/peakwealthmgmt. That's Peak Wealth Management's YouTube channel, youtube.com/peakwealthmgmt. Right back with our friends Nick Hopwood and Jim Pilat of Peak Wealth Management. Gentlemen, let's talk some 401k, HSA, and IRA.
Yeah, Ryan, thanks. With the new year here, new limits, IRS limits are in place. So we figured it'd be a good time to update everyone on what those limits are. So jumping right in, talking about traditional or Roth IRAs, the limit for those that qualify, because not everybody qualifies to put money into a Roth or a traditional IRA. But $7,500 is the new limit this year, up from $7,000 last year, with a catch-up. So at age 50, we get a catch-up in there of an extra $1,100. So $8,600 would be the maximum for someone over 50 to put into a traditional or a Roth IRA.
Jim, you're doing the back door for $8,600 then?
Backdoor Roth is a great strategy that, again, if it works, if you qualify, it's a really good opportunity.
What would make somebody qualify for that? Is there
If you make too much to take the deduction for an IRA, you can contribute to a non-deductible IRA and then immediately convert it to Roth, with the caveat that you don't already have other IRA money.
Got it. Makes sense.
So I'll be doing my backdoor Roth when I get back to the office. Yeah.
Fair enough.
Yeah, so just for information purposes, that limit for Roth contributions, if you're married filing jointly, if you make over $242,000, is when it starts to phase out, whereas you can no longer make a Roth IRA contribution. If you're single, that number is $153,000 is where that starts. So that's when we would start talking about, are you able to make a backdoor Roth contribution?
Got it.
So 401ks, 403bs, 457s, those workplace accounts, limits gone up on those as well. Anybody can put in $24,500. And to clarify, that one is not income limited. So a lot of people overlook what a Roth 401k could do for them. If you make over the limits that we just talked about, it doesn't matter if it's a workplace account. So you can still add to Roth 401k in there. So we highly encourage people to look into their workplace accounts and see if that's an option for them.
Jim, are you going to go pre-tax or Roth this year?
I probably do a little bit of both. I like Roth a lot, and I don't want to ignore it. Pre-tax has its place too, depending on where you are income level wise. So, but definitely, I think a real takeaway for people is, even if you're in a high bracket, don't shy away from Roth. We can come up with a lot of reasons that you should still make Roth contributions, even if you are in a really high bracket today.
Fair enough.
So the limit on those, $24,500. There is a catch-up as well for those over 50. The catch-up this year is $8,000. So one more caveat to this year. This is new with the One Big Beautiful Bill that came out, is highly compensated people, and they define highly compensated people as those who make over $160,000. Now those catch-up contributions now have to go in as Roth. So again, we like Roth, so I don't totally mind it, but it could be a significant shift for some people, where they don't have the ability to put that money pre-tax away.
Government wants their tax dollars right now.
No doubt.
That's what it comes back to, yeah.
What about the HSAs? I know that's more and more increasingly become popular.
Yeah, we like to talk about HSA a lot. We think it's one of the most underutilized accounts for most people. The HSA, why it's so attractive is you get a pre-tax deduction, tax-free growth, and a tax-free withdrawal if used for healthcare. So it's got the best of everything. It's got the best of the IRA and the Roth IRA all built in together.
If you want to have an early retirement, HSA can plug that hole between 60 and 65 until Medicare starts. It can also make Medicare premiums for you, which are continuing to go up. People complain about their Social Security checks. They do go up, but Medicare goes up more. So they end up just spinning their tires.
It's a wash.
Yeah.
There's no doubt. I think a lot of people, in correct me if I'm wrong, what about, depending upon where you are in your life, like for instance, if you have, 2 kids under the age of 5 or something like that, is an HSA, would that be beneficial to you? Because these babies, these kids go to the doctor every other week, it feels like. Maybe that's something that wouldn't be appropriate for them, but if you've got, if you're relatively healthy and you've got a couple of teenagers, maybe that does work. Or do you bounce back and forth? How does that?
Well, look, my view on this is that if we have a high deductible plan offered to us, we want to go for the smallest premium possible.
Yeah.
So that's what I want to recommend, unless you have a health concern. But I think if you do that, you have to take advantage of the HSA. And an HSA requires you to have a high deductible plan. So that's how that works. And then once you put the money into the HSA, don't use it for the doctor's appointment.
Yeah.
Let it grow. like Jim said, triple tax-free over decades.
That's such a great point.
Yeah, and just to kind of put a bow on the HSA, the family limit on an HSA is $8,750. The single limit is $4,400, and there is a catch-up, but I want to highlight this because the catch-up is at age 55 on an HSA, not 50, and that catch-up is $1,000.
Who can keep it all straight?
You guys can, and that's why we are sending people to the website. If you want more information, of course, peakwm.com. You've got everything there. You guys are the ones that keep it all straight.
Yeah, and so Ryan, I gotta bring this up too because we like to pick on our TikTok influencers.
Yes, please.
Yeah, we love to evaluate and address these because all over TikTok and Instagram, you got these guys who are saying that you should not do a 401. It's a scam. Do you believe that?
I don't believe that. I do not believe in that.
Right, because you're not insane. Okay?
Common sense.
Correct. Common sense prevails. So here's the pitch. Okay, they say, why would you put it into a 401? Because it's locked up to age 59 and a half. Okay, so that's point number one that they want to make. But the trade-off is that we have the tax deduction and the tax deferral. And I think it's worth it because you're incentivized to wait. The second thing that they say is that if you put it in the 401, it can't be invested in Bitcoin. And they're just coming from this angle that Bitcoin's going to double every year.
Fine.
And so I just feel like that's a false assumption.
So many people are getting their advice, medical advice, health advice, financial advice from TikTok. And look, more power to you, but it's just not the smart way to go about it.
Completely agree. And so here's where we can blow the mind of the TikTok guy, though. A lot of companies offer brokerage links for their 401, and guess what you can buy in your brokerage account?
Bitcoin.
Exactly. So I want to set up a video with one of these guys and ask them that question and see what they say.
That's the way to do it. Gentlemen, this has been so much fun. I feel like I learned so much when I sit here with the both of you, and hopefully you out there listening to the show learn just as much. If you would like to hear more from Nick Hopwood and Jim Pilat, go give them a visit at Peak Wealth Management. Their website is peakwm.com. If you go to peakwm.com/WJR, you're going to get a free Social Security analysis. And again, we want to remind you all, you can watch us. If you missed any part of the show, feel free to go to Peak Wealth Management's YouTube channel, youtube.com/peakwealthmgmt. That's youtube.com/peakwealthmgmt. Until next time, it's No Lazy Money here on 760 WJR.